The best way to make your dreams come true is to wake up. That's a quote by Muhammad Ali, and my goal is to help promote that awakening. Greetings. I'm Seth Cogswell. This is Not So Passively Aggressive. The purpose of this video series, this is the first, is to serve you, to provide value so that you can make the best possible decisions for yourself, for retirement, for your children. So throughout this process, and it's going to be maybe a little bit of an adventure, certainly for me, throughout this process, if there was anything in particular that you would like to know, any topic you'd like to discuss, please let me know, because that's the whole point. Now, to get started, we'll get started out with a bang, and I'm going to offend potentially as a whole lot of people. And that is, we're going to start focusing on passive investing. Passive portfolios now make up roughly 60% of the US equity market. So it is a massive percentage of the market. Many people have a majority or maybe even all of their portfolios invested in it. And there are some pervasive misunderstandings about passive and what it does, the value that it provides. Not because people don't understand, but because they've been told a lot of stuff that is incomplete. So my goal is to help complete that narrative. So to start out, passive investing, huge percentage of most people's portfolio, and it makes no sense. It's the exact opposite of how every person would say that they want to invest. It's the opposite of buy low, sell high. Now, let me explain why. We're going to use Apple as an example. So Apple is a company. It's operating in the real world, selling really cool products. And if somebody wanted to buy Apple, they'd value Apple, and they would pay this price. Now, then you have the stock market. The stock market is a derivative of the company. It's going up and down. So Apple, the company, for the most part, is just sitting there day to day, whereas the stock is moving up and down. And that's driven by supply and demand, not the actual value of Apple. So let's say at some point, the market accurately reflects the value of Apple. We would call that efficiency. At one point, there was a belief that the market was always efficient. I think people are beginning to doubt that a little bit. But regardless, over the long run, markets have historically been efficient, meaning the stock accurately reflects the price of the company. Now, that price of the company within the S&P 500 is a big driver. It's one of the two main drivers of the weighting that it gets in the S&P. So the percentage that is invested in that company when somebody buys a share of the S&P. Now, back to Apple. Let's say somebody is at home working on their MacBook, and they're like, man, my MacBook is incredible. And they turn around and buy a bunch of Apple stock. That demand for Apple's stock will push the price up. That's what demand does, pushes prices up. Now, keep in mind, the value of the company hasn't changed at all. They bought the MacBook a while ago. They didn't buy a new MacBook. Company didn't change, but the price of the stock is now higher. Because the price of the stock is now higher, the percentage of the S&P that will be invested in Apple, if somebody buys shares of the S&P, will be higher, right? So Apple's price went up. Now the percentage that it makes up in the S&P is higher. But again, the value of Apple didn't go up. The whole reason you are now paying more for Apple or buying more Apple is because somebody bought it and because it's now overvalued. This gap between fair value and where it is now is overvaluation. That overvaluation is the difference between what you would have, the amount of shares you would have bought before and how you're buying now. Now, let's say a momentum manager sees Apple and they're like, man, Apple's flying. I got to get some of that. So they pile into Apple, which pushes Apple quite a bit higher. Now, that new price will have a new weighting so that anybody that invests in the S&P from here on buys more Apple. Again, that difference is overvaluation. That drives the increased amount of Apple that you buy. So again, you're buying more and more and more because it's more and more overvalued. The flip side is also the case where if somebody sells Apple, now the percentage in the S&P is lower and you're actually buying less, which I would say if a stock is cheaper, but the value of the company is worth more, you want to buy more. So again, it's the opposite of how every single person would say they want to invest. There's also no sell component to the S&P other than it just holds things all the way up and then all the way back down. And maybe if the committee that runs the S&P says, we don't want this anymore, they sell it. That's it. So again, it's the opposite of buy low, sell high. It's the opposite of how every single person would ever say they want to invest. Yet, roughly 60% of US equities are invested in passive portfolios like this. Here's why this really matters. So in addition to 60% being invested, a higher percentage of US household wealth, or the percentage of the average household, is now considerably higher than at the tech bubble that is invested in stocks. So people have a lot more stocks. In addition to that, 41% of the index, the S&P 500, is in 10 companies. At the peak of the tech bubble, that was 27%. And the forward PE, which is the price earnings ratio, you're looking at the earnings that these 10 companies are supposed to make. And the forward PE is a way to value how much you're paying for those earnings. It is roughly 50% higher than it was at the peak of the tech bubble. The peak of the tech bubble was crazy. I bet a lot of people, including myself, probably thought that we would never see it again. Instead, again, it's more concentrated and 50% higher as far as basically the price that you're paying, which is crazy. Now, the question is, how did we get here? In the 70s, 80s, 90s, 2000s, there were very few ways to invest in the stock market. You either bought a mutual fund, you did some research in your local newspaper. I certainly used to do that in the past. Or you had a stockbroker that was slinging hot stocks. Regardless, none of those were ideal. As far as mutual funds go, many would invest in, say, 300 companies, which would all but guarantee performance in line with the S&P. So providing no value, and they would charge 2% for no value. And they'd just sit back, make a whole lot of money doing absolutely nothing. Now, in a roundabout manner, John Bogle, who founded Vanguard, ended up on this path of creating Vanguard. And because it was a mutual construction for a company, we won't go into that, it's complicated. Regardless, it's good for investors. And because of that progression, he was able to provide market-like returns for a tiny fraction of the price. So now he's providing basically what these mutual funds were charging for a lot less. Made a ton of sense, offered a whole lot of value. And luckily, Vanguard grew. Also luckily, maybe not for investment managers, but it drove fees down across the board. So it's been Vanguard, John Bogle have been very good for the investment industry. But again, going back to what I said earlier, the actual portfolio or the approach makes no sense. It's the opposite of what we would all say we want to do, but it has positives, so it's a give and take. Now, again, why this matters is where we are today. A lot of people have a whole lot of money in passive. And there's been hotter momentum than any time in history. Last year at the 99.8th percentile in history. And so passive has had its best run ever, which is great, but things go up and down. And if it's gone up a whole lot, the opposite is a risk. Now, Michael Burry, who is he was in The Big Short, or featured in The Big Short, recently posted that due to some apparent financial shenanigans it appears that the biggest companies in the index might be doing a few things to make earnings appear more attractive and higher than they are, which would make valuations appear lower. He used the word fraud. Not going to use that word. I have no idea, but it's a risk. And so if this comes to pass, and then you magnify that with 41% being invested in just 10 companies. Again, that's 50% more than the peak of the tech bubble. And then you magnify that with valuations of those top 10 holdings being 50% higher than the peak of the tech bubble. It is more risk than we've probably ever seen before. And again, in a portfolio that isn't buy low, sell high, it's buy higher, buy higher, buy higher, never sell, which kind of sets it up for what is happening today. So again, the purpose of this series is to simply educate, help others view their investments, which is a big part of our lives and our livelihood, in a slightly different manner. Hopefully peeling away the salesy stuff that has been thrown at us for years. I'm not going to be providing hot stock tips. If that's what you're in for, maybe go check out Reddit. That's it's not the purpose of this. The goal again is to serve you, to hopefully help in any way that I can provide a positive impact on your future. And if anyone else comes to mind where you feel this is merit, please pass it along. Please like it. The more that we can get people thinking critically about these matters, the better we'll all be. I'm Seth Cogswell, and this is Not So Passively Aggressive.